Yeah, just before we get going, I'm just checking that you can all hear me okay. If you can't hear me, please just put it into the chat box. Just make a comment and I'll try and sort things out. But you should be able to hear me okay. You should be able to see the slides on your screen, and you should also see a video of me as well. But if you don't see that stuff then, or hear that stuff then, yeah, just let me know. Before we get going on the webinar, as ever, we've got a risk warning because the information I'm going to be talking about is live market information, and this video, the webinar is just for educational purposes. It's for information only. It's not to be taken as investment advice for you. So you must understand that. Now, in terms of what we're looking out for in the webinar, the slides that I've got are available if you wanted to get a copy of the slides. That's no problem at all. We can sort that out, but just let us know towards the end and we can get on that. But what we're going to talk about is just the general big picture stuff about what's happening in the next few weeks for Q1, how that is going to impact on sort of economies and how major markets are moving. I'm then going to drill down into Forex markets. I'm going to look at some commodities and look at some equity markets as well. And if at any stage you have any questions, please feel free to put them in the chat box. I've also got the question and answer box open as well. But either of those should be fine for questions. I should be able to see them, hopefully. And if they are to do with exactly what I'm talking about at that point, I can elaborate on some stuff. But if it's sort of more general questions and topics, then I'll sort of leave it more towards the end. But yeah, it's so any questions and queries, just put them into the chat box and I can hopefully sort them out. But you will have an opportunity at the end of the webinar to do a Q&A for anything that you are thinking about in terms of markets and trading, and I will do my best to answer those questions for you. Right, okay, so the sort of, as 2022 has come into play, markets have been increasingly volatile, and that volatility that we've seen coming in the early part of January has been driven by markets being sort of, I suppose, fearful, but sort of worried that central banks are going to be tightening monetary policy, and tighter monetary policy by central banks means that because basically for the last since COVID, everyone just cut interest rates to rock bottom levels. Everyone was on a level playing field, so you don't really get a lot of sort of differential between various major central banks. So when the central banks do start to move, you then get big pricing differentials for bonds, and that affects currencies, and currencies affect bonds and currencies affect stock markets and commodities. So it all sort of plays into that. And because primarily the Federal Reserve is raising interest rates, or about to raise interest rates probably in March, because that's going to start off, the markets are increasingly sort of worried about the impact that that's going to have on their on the markets that they're trading. And you're seeing volatility levels significantly higher. And if I show you the volatility gauges that I use, we sort of start with the VIX, for example, the VIX volatility of S&P 500 options. You can see it's spiked higher, and especially in the last week or so, but it has been rising sort of in the last few weeks or first couple of weeks of January, but then obviously in the last week or so it has really taken off as markets have become increasingly fearful. And the reason is basically because of this, because you've got bond market volatility going up, As I said, when central banks start to move on interest rates, then you tend to get more volatility through bond markets, and bond markets tend to be the driver of major financial markets. And that certainly has been the case with bond market volatility going up. Currency volatility has been a little bit sort of wavering. That was basically over Christmas, that drop over currency volatility. Currencies become dead over Christmas. But then since then, it's sort of spiked back higher again. You can see that the volatility has increased. And again, it's increasing as risk aversion has kicked in for another bout of risk off trading, and currency volatility is higher. So all these sort of major markets, bonds, equities, currencies, all seeing increased volatility into January. And as I said, that is because we've got the central banks looking towards tighter monetary policy. Now, in the next couple of weeks, we've got the Federal Reserve, the Bank of Canada, and the Bank of England all reporting monetary policy. Question is, are they all going to be tightening monetary policy is the question. They could conceivably all tighten monetary policy. It is possible, although unlikely that the Federal Reserve will tighten monetary policy to any significant degree tomorrow. But the Bank of Canada could, and the Bank of England could also on the 3rd of February. So these central banks all in focus in the next couple of weeks, and all going to be key, I think, for markets in the coming weeks. So how aggressive will these banks tighten monetary policy? Inflation is going to be key. Inflation all around the world, inflation is really important. Higher inflation means that it affects an economy in a negative way. Subsequently, central banks can tighten monetary policy to try and bring inflation down. And when that happens, as I said, the volatility of major markets increases, and you get the knock-on effects through bonds, currencies and equities. So inflation elevated, and it's been a big feature of major markets through the latter stages of 2021. Well, throughout 21, really. I suppose if you look at this, you can see all of these inflation lines going significantly higher. US, this is core inflation, 5.5%. UK not far behind, Canada not far behind that. China and Japan are still a little bit less so, but they have been increasing. But the question, I suppose, is whether inflation is now starting to sort of fall over, really, just starting to moderate slightly. And if that does happen, then that will affect central banks. The other key factor is COVID still. COVID developments. Is Omicron starting to wane slightly? Is it starting to, the infection rate starting to come down? Well, if you look at these major infection rates of major economies, big European ones, and the US, you can see that these lines are starting to roll over. UK is rolling over, US rolling over, Canada already falling away quite nicely, but there are still sort of sharp rises in France and Germany, still having to cope with rising rates. So it's sort of a little bit uneven at the moment, but there are still signs that maybe Omicron is starting to reduce, which is again going to be helpful for economies coming out of the latest wave of infections and then reopening in a good way. And the question being whether Omicron is actually the beginning of the end of COVID. That has been muted. Obviously, we have in vaccination rates which are improving. You've got the fact that Omicron is arguably less dangerous as a variant of COVID than other variants that we have had. So there's potential that maybe the Omicron variant is starting to sort of see that the danger of COVID, obviously, which is, I mean, he's still a dangerous virus, don't get me wrong, but the danger is receding potentially. And that could be helpful, but we still need to see vaccination rates improving, and vaccination is going to be the key to getting rid of COVID as a pandemic, certainly. But Obviously, if the pandemic is moving out of the way, then that becomes one less key concern for risk appetite. So that's important as well. Okay, so macro factors, the big factors that we are looking out for. As I said to you, it is all about bond yields, all about the Fed in the early stages anyway. So tomorrow we have a Federal Reserve meeting. This Federal Reserve meeting, that in the past week, we have had a really significant sell-off on US equity markets, really big sell-off. There's sort of been an acceptance that the Federal Reserve is going to tighten rates by 100 basis points or 425 basis point rate hikes this year. It's just a question of what it does beyond that. Does it then also start to run down the balance sheet? That's sort of another form of monetary policy tightening. How aggressive is the Fed going to be? If the Federal Reserve tomorrow could be a crucial indicator to markets in the coming weeks. We've had this big sell-off on risk appetite, but it's been a really significant move that maybe has gone a bit too far near term. So I'm going to show you equity markets later, but it could be that if the Federal Reserve just takes a bit of a step back on its tighter monetary policy, then we could quite easily see these equity markets rebounding. There is the potential signs that that is already starting to come through today, although markets are a little bit wavering this morning and into the US session. But there are signs that maybe that support is already starting to come in. Maybe near-term oversold conditions start to sort of turn back, and then markets can rally again. So that will be the key tomorrow, whether the Federal Reserve just sort of blinks a little bit, just maybe just steps back a little bit from its tighter monetary policy. As I said, we've also got the Bank of Canada. Bank of Canada, the probability, according to interest rate swaps, probability is around about 70%. The market thinks probability of a Bank of Canada rate hike tomorrow. So that it could be the Bank of Canada makes the next move. Also, the Bank of England is almost nailed on to have an interest rate rise in February. Now, markets have been really bad at calling the Bank of England in the last two meetings. It thought there was going to be a rate hike in November. The Bank of England didn't increase rates in November. The market thought that the Bank of England wasn't going to hike rates in December. It did. So the last two meetings, the market has called it wrong on the Bank of England. And there's been a lot of volatility on sterling as a result of that. So again, more trading volatility could be seen on the Bank of England. Other central banks, Reserve Bank of Australia, reacting to higher than expected inflation and a tighter labour market. Does that increase chances of a tighter monetary policy for Australia? And also the European Central Bank as well. How do they sort of react to higher inflation and the end of its PEP program and potentially tapering asset purchases? All these things that we need to consider in the next few weeks. As I said, COVID, new variants. Will a new variant emerge in the coming weeks? Probably. At some stage when Omicron fades out, you're likely to then get another variant coming through and more dominant. How would that impact markets and economies? Would there be any need to have more lockdowns with the degree of vaccination rates still sort of improving all the time? So the question, I suppose, is, are we beyond the threat of COVID now to markets? Do we need to still think about COVID as a big threat? And finally, just another one of the reasons why, again, markets have been so fearful in recent days is this threat of potential conflict between Russia and Ukraine. And I suppose with Ukraine, you add in the NATO countries as well on the Ukraine-Russian border. Russian troops are massing. NATO forces are sort of trying to counter that to an extent. But does Russia try to come over the border and do some sort of invasion of Ukraine, or how does that play out? Now, obviously, markets tend to be a little bit cautious and risk negative when geopolitical risk is rising. So, is it that's one of the reasons why we've seen the gold price performing well recently? So that is an issue. So the traditional correlations that I do like to look at ultimately haven't been all that decisive recently. Real yields have been rising. You've had inflation expectations falling, and you've had US Treasury bond yields rising. So when bond yields rise and inflation falls, the real effect of bond yields, or real yields, is sharply higher. Now, theoretically, that would be, through the normal course of events, that would be positive for the dollar. No, it hasn't been exceptionally positive, although in the last sort of week or so, US dollar has been rallying. But traditionally, the US dollar would have been a lot stronger, bearing in mind that this increase we've had in real bond yields, it hasn't really played out that way. So there's not a great correlation there at the moment. Also with gold as well, a very, very strong traditional negative correlation between gold and real yields, because gold is seen as a zero yielding asset. So when interest rates are rising and real yields are rising, so inflation is effectively falling versus interest rates, which is what has been happening, as I showed you on this chart here. Inflation falling, inflation expectations falling, bond yields rising. That effectively means interest rates going up. Now, that should be negative for gold. It hasn't been. One of the reasons is that because of the rise in bond yield, I think the rise in bond yields has been so fast and so sharp that markets have been fearful in early January 2022, and that has helped to support gold. You add in this issue surrounding Russia and Ukraine, again, you sort of seen gold find a bit of support on the back of that. Silver is another one. Silver actually rallied sharply with real yields throughout the early weeks of January 22, just fallen off a little bit, and you could argue even in line again, but silver should be having a negative correlation. Again, a zero yielding asset should be would the opportunity cost, and that means that there are other investments you could be buying that actually produce a yield, like higher yielding equity markets or value stocks, versus gold and silver, which don't yield anything. So zero yielding assets have an opportunity cost when bond yields are rising. But at the moment, silver has been trading in line with gold, with real yields. So that's strange as well. So all these things are happening at the moment, which probably are not going to last. As I said, minus 0.41 average correlation since 2020 on silver. Very strongly negative average correlation there. So traditionally, silver and bond yields go in opposite directions. Bond yields are going up at the moment. So theoretically, silver should be going down, but it isn't. Again, interesting lack of correlation there. So if also, actually back on those, if you look at NASDAQ, okay, S&P 500, traditionally, again, has a very strong negative correlation with real bond yields. You can argue, certainly in the last month or so, that has been a really strong negative correlation. It's even stronger when you look at versus NASDAQ. NASDAQ's a really strong negative correlation at the moment between bond yields and the NASDAQ. So falling bond yields, rising bond yields and falling NASDAQ. If that continues, bond yields continue to rise, then NASDAQ will be under pressure to the downside. But you can see in the last sort of just few days, bond yields just starting to sort of fall over a little bit on real yields. So maybe we start to see NASDAQ picking up again. couple of other factors to consider. And as I said, volatility is elevated, and we believe will continue to be so in the coming weeks. Right. Okay. So let's just have a look at some of these forex markets that you'll be trading potentially. Now, what we've got is that we've had the US dollar recovering in the last sort of few sessions, really, last week or so. US dollar has rallied, but generally speaking, since the beginning of December, as markets have sort of, I think, increasingly priced in the tighter monetary policy for the Federal Reserve, I think that the US dollar has been under pressure. It's been falling away, and that subsequently succeeded in breaking this uptrend. And I think that was a key moment, that uptrend breach. Because I think the fact that this market is still looking corrective, you're still running lower highs in this move, and I think that we may have even seen the dollar index topping out now. It is possible that we've seen the top in the dollar. Not guaranteed, but it is possible. And the reason is that we're starting to see long positions, net long positions on the dollar starting to fall away. You can see this. This is futures markets. When the line is above zero, it means the futures positioning is net long. They've got net long contracts or net long on the dollar. When this line is below zero and negative, the market is net short. At the moment, it's been net long, but it seems as though that it's hit a level, it started to fall away, and it seems as though that the market has fully priced in the rate tightening of the Federal Reserve, certainly for 2022, certainly fully priced. So if that's the case, you're likely to see longer term positioning for US dollar no longer sort of becoming long. You're likely to see some of those long positions being closed out. And if that is the case, then this rally in the dollar is likely to find a bit of resistance now. You may well see that this rally in the dollar starts to falter. And I've put on the slides between 96.50 and 97. I think that is a fair sort of way of looking at it, because I think that if the market has fully priced in the Federal Reserve rate tightening, then why would markets continue to push a longer dollar? And when you have that in mind, and then other central banks start to make signs of tightening monetary policy, the relative sort of differential between, or the difference between the central banks is reduced. So subsequently, the dollar loses its attraction versus other currencies. And you've got currencies such as the Canadian dollar, you've got currencies such as the UK pound, the sterling, perhaps even the Australian dollar, if Omicron falls away, and then you get a nice position for economies to perform well in 2022. That will benefit the Australian dollar, being a pro-cyclical currency. So all these currencies are in a decent position to perform better against the dollar, and that's why I think that the US dollar may start to fall away. And I've said here US dollar to underperform the Canadian dollar and sterling, but I've also said that the US dollar may start to trade in a range versus the euro and the yen. And you can see here, if I get the MT5 platform up, you can see on euro dollar that, I mean, it's a very it's a chart that is pretty much the mirror opposite to dollar index. But you can see here that this recovery that we're seeing has just sort of come under pressure in the last sort of few sessions, broken down. And you could get a test of the 112 big figure, 111.85, and you might even get a small move to the downside below that. But I just look at this chart and I think, well, I think this is in the process of sort of finding a low. It may not have definitely found a low, but I think that given the fact that the US dollar looks fully priced, that would suggest that euro it will start to get more positive against the dollar, and we might see a move higher. And I've sort of got on the slides here that I think that you might say, as I said here, test of 12 big figure, but expect 11 to 11.15 with a ranging move throughout Q1. And I think that could well be seen. I think because, as I said to you, that if the Federal Reserve gets a little bit worried about what's happening in markets at the moment with all the volatility and this big selling pressure, it may well try to take the steam out of that by just sort of being a little bit less aggressive in its rate tightening. If that happens, then I think you could quite easily see US dollar falling away in the coming weeks. So that is why we're very much going to be focusing on how the Federal Reserve comes out tomorrow. Now, what we have other major themes is how the central banks really sort of guide monetary policy in the coming weeks. Now, the ECB is sort of coming to the end of its PEP program. It's sort of going to be sort of positioning for further bond purchases and asset purchases. But does it then sort of start off that by just sort of guiding towards a taper of asset purchases throughout 2022? Again, that could be something where the ECB starts to look a little bit less dovish than it did before. And if that again is the case, then you're likely to see a bit of positive move from the euro. Sterling, again, another one, supported by rate hike potential in February. Certainly that the case, but volatility is likely to be high, I think, for sterling in the coming weeks. You've got EU versus UK trade talks still ongoing, still trying to iron out the difficulties of the Brexit deal. You've also got political risk in the UK as well. The UK Prime Minister Boris Johnson is under a lot of pressure to potentially even resign because of how he has acted during the COVID lockdown and sort of basically running a government that basically constantly lies to Parliament, lies to the public, and the UK public are not going to take kindly to that. So the potential is that he may even have to resign. So that could add in political risk factors. So you're likely to get a big volatility actually on sterling dollar positions. So any UK pound positions that are taken, I think, in the coming weeks needs to be very closely thought out with regards to stop losses and how volatile the intraday moves are on sterling. Australian dollar is another key factor here as well. The Reserve Bank of Australia potentially becoming less dovish. The Reserve Bank of Australia is at the moment sort of guiding for 2023, potentially 23, as a first time to hike rates. Well, some of the banks that look at the Australian dollar and the Reserve Bank of Australia are suggesting that maybe the first rate hike could be brought forward to September or even sooner. So that, again, is likely to drive some positive moves for the Australian dollar if that is the case, and certainly if the Federal Reserve is a little bit less aggressive in its policy. So Aussie versus the dollar could well find some upside move in that. That central bank decision for the Reserve Bank of Australia is 23rd of February. So it's about a month away. About a month away. But next month, there'll be a lot of talk about whether the Australian central bank is going to just be less dovish, I think. And finally, the Bank of Canada, the Canadian dollar, I think is likely to find positivity. The Canadian dollar, it benefits from a stronger oil price. Oil price has been moving strongly. And I'll talk about oil in a bit, but also the Bank of Canada is likely to increase rates. If not tomorrow, it will do in the subsequent meeting. So that gives us a few trades to look at: euro dollar, cable, Aussie, and dollar CAD. Euro dollar buying into weakness, cable supportive weakness, and Australian dollar. These are all sort of US dollar negative trades, I might add, interestingly enough. So to get onto this, this is euro dollar. So I said euro dollar around 112, 111, 112. I think anything that finds support, I think that could be a buying opportunity around that. You've got sterling dollar already back into this band of support, which if I get the crosshair, sort of comes in around the sort of 34 area to 35. Anything around that looks to be buying opportunity time, I think, on if it starts to find support, because I think that sterling dollar has potential upside, and it's had this quite sharp retracement, but it's into support now. Australian dollar has broken its uptrend, its little mini uptrend, but again, is this sort of between 70 and 71? Is that sort of buying opportunity area in the coming weeks? I think it could be. I think it could be with how the Australian inflation data has already been supporting Australian dollar today, and I think that could continue to do so. So I think Australian dollar starting to rally against the US is not is quite possible. Now this is Canadian dollar, and a stronger Canadian dollar versus US means dollar CAD moving lower. Dollar CAD spiked higher in the last couple of days. We've had the oil price falling off. We've had general risk appetite turning negative, and that all adds up to dollar CAD going higher. But I think that dollar CAD is going to start to sort of consolidate, maybe find a bit of resistance, and then start to fall away again. And as I said, if that Canadian dollar, if the Bank of Canada does increase interest rates tomorrow, then you're likely to see that dollar CAD moving lower, certainly to test this low around 24.50 and possibly towards the big range lows in the coming weeks, around 22, 23 figure. Right. So commodities. Now, commodities will be, I think it's an interesting one, commodities, because if you look at what's driving gold at the moment, you've got, okay, risk appetite is negative at the moment, so that helps gold to find support. You've got the Russian Ukrainian situation, again, that helps gold to find support. As I said earlier, the gold price is not running as it should be, with real yields having spiked higher as they have. That shouldn't be good for gold. The only reason that gold has been finding support on the back of market moves in recent days and weeks is that risk appetite has been so negative. I think that at some stage you're likely to see that gold will struggle. And if that is the case, which I think it is, then I think that gold is going to continue to play this trading range that it's been in since June. I think up towards the top of the trading range. I think it then struggles, and then we'll do a mean reversion back towards around about $1,800. $1,800 is, it's fairly consistent. I mean, if I put let's put a horizontal line at $1,800. So it's just 1,800. You can see it is quite a consistent pivot line for support and resistance. And it's a line that often you'll see the market returning to. So it's quite likely that I think that the gold price may, I mean, it's had another go higher today, actually in the last hour or so, and it's retraced again. Again, it might continue to go higher in the near term, but I just don't think that it's going to sort of be able to last too much beyond there. When I think when markets start to settle down a bit, and there's volatility which has spiked in recent days, and when that starts to settle down, I think gold is going to fall away again. And so I think this is a near-term move, and obviously it's again looking to move higher today. 1877 is that high, but once it hits 18, sort of hits resistance, I think that it's going to start to fall away again. And I think $1,800 there or thereabouts, which is basically bang in the middle of the range. This sort of medium to longer term range that it's now developed, and I think it's going to fall back into the middle of that range. Now, silver is another one which has been interesting. Silver has again been rallying in recent sort of sessions and last couple of weeks. Again, arguably, it shouldn't have been rallying as hard as it has done, and it's sort of fallen away as risk appetite has really suffered in the last couple of days. But again, it's sort of pulling back to sort of mid-range levels, and I think that is going to be a feature of trading in the coming weeks, is that it just sort of reverses back into the middle of this range. And that middle of the range is sort of 23.50 area. I think it's going to continue to sort of be attracted back towards that. It's going to struggle to sort of sustain upside moves, and that's going to unwind back towards there. So I don't necessarily trust too much further upside in silver if it does happen. Now, the one that I do like, I think on a fundamental basis, you've got again the argument that if Omicron is starting to sort of just sort of reduce its impact on major economies, then demand will increase again as these economies sort of get up to full speed. And I think that you've got that positive demand story that will be coming in the next few weeks. In addition to what OPEC Plus have said about supplies, which is that they're comfortable with the levels they're at the moment. It's unlikely that they're going to be increasing supply levels, and if demand increases, then demand outstrips supply, and that pushes the price higher. And that's one of the reasons why we have had oil rallying higher in recent weeks. Now, what you've seen in the last few days is that it's just sort of hitting the buffers a little bit, and there's a little corrective threat coming in. But I think this sort of breakout area, 80 to 82, I think that's likely to be a good band of support now. You can actually date that back to sort of September time, September 21. So I think that that's a fairly good line of support now in the low 80s. I think anything back towards that finds support, I think that's a buying opportunity on oil. And again, if oil does sort of continue higher, then that's going to help the likes of the Canadian dollar on that. Right, let's have a look at indices. Now, this has been the real story of 2022 so far. Indices have been so volatile, so volatile on equity markets. As I showed you earlier, we've got the VIX volatility, which has, if I can find it, VIX volatility has spiked higher and it remains high. High volatility really does impact negatively on equity markets, but also the fact that that sharp rise in bond yields has had such a big negative impact on US high growth indices such as the NASDAQ. Now, if we look at, sorry, while this chart loads, if it loads, hopefully it will. If we look at how Nasdaq has been performing against the S&P 500, and especially against some of the less growth oriented European indices, you get markets that are showing that the Nasdaq is under big issues at the moment. Big sort of flow out of the high growth Nasdaq more into the value stocks, which are dominated by the Dow. Goodness me, this loading is very slow. So that has been a key feature of 2022 so far, and you can see here. There we go. 1 month performance has been really negative on the Nasdaq. You can see that it was at the end of December. It was one of the best performing indices. It's gone from one of the best to the worst. And it's interesting that the S&P has been dragged lower, but also the Dow as well to an extent. The Dow has struggled to sort of be contained from that selling pressure. But look at FTSE 100. FTSE 100 actually over the course of the past month, look at the Nasdaq, down 10% in the course of the past month. FTSE's up 2%. And the reason is because FTSE is jam-packed with value stocks, high yielding, less growth-driven stocks. You get oil stocks being key focus in FTSE. You've got financials. You've got the very there's no tech at all. I think apart from one company, and I think it's Sage. There's virtually no tech stocks in FTSE 100, and tech stocks basically are the Nasdaq. So Nasdaq being massively mauled by the tech stocks, FTSE 100 has no tech weighting at all of any note, so it's held up fairly well. DAX, a bit more growth driven than FTSE, but still very little tech, so it's performed much better than these Wall Street indices. Now the question, I suppose, is does that move continue lower or not? Well, yeah, I think that it'll be very interesting to see what the Federal Reserve does tomorrow. If the Fed is a little bit nervous about what's going on in financial markets, and Jerome Powell maybe mentions it and talks about it, we could quite easily see equity markets rallying quite hard because they're so oversold. I did an article on the website today talking about how US markets have fallen so strongly. Now these are the declines of any real note, and the drawdowns since the pandemic. 30%, 35% on S&P 500. Now the S&P 500 has fallen 12% from the highs. It's the biggest drawdown we've had since the pandemic, since the real sell-off. But it is oversold, technically oversold. Nasdaq down 17% from its high just at the beginning of January. 30% was the biggest move, obviously, in the immediate aftermath of the pandemic hitting. So again, 17% is by some considerable way the biggest drawdown that the Nasdaq has seen since the pandemic original sell-off back in February, March 2020. So big selling pressure on these indices, but are they now going to be buying opportunities? I think they could be. I think that ultimately in the coming weeks, probably throughout 2022, really, I think these equity markets for the US are going to be very volatile, but also I think they're going to be ranging. And so ultimately, I don't expect to see this move going too further to the downside. It's had initial selling pressure, and as Wall Street has opened today, it has had a move to the downside, but it's equally has now started to rally again. I think that there will be buyers that come in. There was a suggestion that retail investors were really panicking out of stocks yesterday. as this sell-off accelerated yesterday morning. The market is obviously higher since then, and I think that again it could be that this is a buying opportunity level. Look at this S&P 500. Yeah, it's broken that uptrend, and that tells me that it's no longer going to be sort of breaking new high ground or sustaining that move, but it's a massive line of support. Look at the importance of this support around 4,220 on S&P futures. Really important area of support that is now starting to come in. 4,220 to 4,280 area. Massive, really big support. And it's interesting that the market has turned higher from that area today. So I think that this could be sort of buying opportunity area for S&P 500. Just obviously at the moment there is volatility that is still in market. Market is still very nervous, but I think if the Federal Reserve does show any sort of sign of nervousness tomorrow, I think we could see a big rally coming back in, because it would suggest that maybe the Federal Reserve is not going to be so aggressive on its monetary policy tightening. Let's have a look at NASDAQ. Look how oversold NASDAQ is. Has fallen away again. Yeah, I was saying in the report today that this resistance line, sort of 14,350 to 14,500 area, is big resistance now, having been supportive. That line of support that S&P held, NASDAQ is breaking, but it is oversold. So it is into the realms of technical rally territory. So certainly I'm keeping that in mind. So looking at the European markets, I mean, look at the DAX. DAX has basically been in a range for the last 9 months or so. Look at the number of times it's spiked back towards this 14,800 to 15,000 area and bounced from there. Again, it's had that as today's traded low, 14,975. So big support continues to come in around this sort of 14,800 to 15,000 area. Yeah, it is still sort of falling away, but again, it's sort of back at around this level, oversold on RSI, around that 30 level. All these spikes on the RSI coming down towards 30 and below 30. This is the opportunity. These are the opportunities market sees. So again, is this buying opportunity time? Obviously, at the moment, markets are still in a volatile state and still negative. So it is not by any means a risk-free trade. It's it is a pretty high risk trade at the moment, given how the fact that markets are still falling. But if support does start to build, I think that this could be sort of buying opportunity territory, because time and time again, the DAX has sort of hit this band of support and rallied. Band of support and rallied. Back to this band of support again. 14,800 to 15,000 area. Number of times it's hit it. Even on an intraday basis, this sort of support continues to come in. It very rarely, it hasn't actually closed below 15,000. All these times it's sort of come back to this area. It's never closed below 15,000. So again, if you see a 14 handle on that, that's sort of gives you an indication that the market likes to buy it at that level at the moment. FTSE 100, again, sort of actually FTSE 100 is my preferred play at the moment, because it gives you that element of sort of insulation, given the fact that it's high value orientation. But look at this uptrend. It's a strong uptrend. It's bands of support. Old support become old resistance become new support. And you've got this band of support. This really important level comes in around 7,180 to 7,250 area. Old resistance becomes new support, and it seems to be again that happened. Again, you could argue coming in today, there's a band of support around here at current levels, 7,360 to 7,400 old support. So this is really an interesting moment for FTSE 100. That's a bull hammer candlestick. So again, is this an opportunity for FTSE 100. Markets start to settle down, I think there could be some buying opportunities coming in these markets. Right. Okay. So if you've got any markets you want me to look at, please just drop it into the chat box and I can take a look. If you've got any questions surrounding what I've talked about today, please just ask, and I'll sort of run through some things. But yeah, I'm sort of at your disposal for any questions and answers that you might be interested to know. So anyone who's got anything, please just ask. If it's something about the platform, I can hopefully help you with that as well. If you're on the MT4, MT5 platform, I can give you a bit of a hand with that, or anything about market moves. Yeah, just no problem. But if you haven't got any questions, then I will say good luck for your trading. I'll leave it another minute or so, see if any questions come through. But yeah, thank you very much for coming, and I will speak to you all next time. Okay, so there's a question about gold. I'll quickly have another look at gold. Gold is up or down. Near term, it's going up. It continues to move high. You can see this run of higher lows and higher highs. It's holding the breakout. It's looking to push higher. That is encouraging near term for gold. And you can see this good line of support, 1828. Good line of support there, 1828 to 1832. Look to break out today, but it has pulled back on that break, although it's just starting to tick higher a little bit in the last few minutes, last half an hour or so. But I think that this run higher on gold is a move that could, I think it has further to go on the near term, but I think that I'd be cautious of chasing gold too much further from here. I think anything around anything that starts to struggle around the sort of 1850s, 1860 area, I think that may well start to sort of fall back again. So that's the concern I've got for gold, that it's looking okay on the near term basis, but it has this tendency to pull back quite sharply, and that's the concern that I have with being long on gold at the moment. I hope that helps you, sir. Right. unless there are any other questions, I will wish you good luck in your trading, and I'll speak to you next time. Thank you very much.